Alright, Freedom Builders, welcome back to the channel. Today I am going to do a little video called Stocks of the Week. You know that I normally do Stock of the Week like in one stock and I go in depth with that. But today I have taken some few requests. I've taken some of the stocks that most of you have suggested an analysis on, and then I have bundled them in one video. That means that I'm not going so much in depth with every single video, but you'll have three stocks instead that I analyze quickly. That is Microsoft, it is Facebook, and it is Mastercard that we are going to look at. And I'm going to look at them from a technical side, from the graph, and then I'm going to go through quickly the numbers, meaning that I'm not looking so much in depth as to if there are any mergers coming or, you know, all the details, all the qualitative details that I normally go into, where I look at the possibilities, the future possibilities for their products and so on. So today will be kind of a brief view on the three stocks, and then you can do your own research. Anyway, you should always do your own research. I'm not a financial I'm not a financial advisor, I should say. So you should always do your own research. Don't just listen to me. That is important. All right. If you haven't done already, please hit the subscribe button and the like button and all that down there. And then let's start moving. We have Microsoft up here, and as you can see, one of the things I'm looking for, and you know that if you have followed me for a while, let's just find the right button here. What I'm looking for is trend, and we can draw a trend channel quickly with the regression channel here. That is taking a regression line in the middle and then plus and minus 2 standard deviations here. That shows that Microsoft is doing a very good job at staying inside this channel, and that is a good sign. And we are not right up in top of the channel, so there might be some room yet to move. It was down, of course, I should say, because of the big crash and everything was down here. But right now, our first criteria, visual criteria, the trend is up, meaning that there's buyers for the stock. That is a good criteria, I think. Also, we can see down here, the RSI, 14 periods, is above 50. We like that, meaning we're in an uptrend. And the CRS down here, the comparative relative strength, where we are measuring it towards the S&P 500, is also way up above its two moving averages. So the stock is moving faster than the overall market. Very good. If we are looking at the daily chart here, we can also see that we are in a nice uptrend. We know that from the turning point here in March. And yeah, we have been moving up, and there's not so much slowdown here. Even though the market is a bit down today, the stock is actually up 1.5%. So that is very good. All right, so the graphical part of it is actually very fair, and there's nothing to complain about there. So let's move on and look a bit at the numbers. When we're looking at Stockopedia here, that is where I normally start to look. We're looking at their proprietary ranking tools over here, and we can see that the stock rank is 89, and it is up over the last 30 days. That means that it is doing better than just around 90% of all the stocks when you combine quality, value, and momentum. You can see that value is very low, and I'll get back to that in a second because we can see that in the fast graph platform as well. Quality 99, meaning that it is outperforming 99% of the stocks here, and the same with momentum. If we're looking down here, we have a PEG ratio, that is the PE ratio divided by the future estimates, and that I like that to be around 2, but 2.8 is okay. You can see it's a bit worse than the industry and the market overall. You can also see the earnings per share growth forward is 11.4. Down here we have some very nice numbers on the return on capital, return on equity, and operating margins, right where they should be. Health trend, that is the Petrosky F-score, 8 out of 9, perfect. We're looking at the trend here on normalized earnings per share going up just like we like it. We have the free cash flow here also going up in a straight line, also just as we like it. For those of you focused on dividends, we have the dividend growth here. That is quite nice. It's growing with a nice percentage every year. It's not very high dividend, 1.1%, but that is fair enough. They have a dividend cover of almost 3, so that's how we like it to be. The liquidity, current ratio, quick ratio, and interest coverage they are very good. And yeah, pretty much there's nothing much here to see. We can see they are covered by 45 brokers and they are all in the strong buy area. So, all right. Actually, on the graphical visual part, on these numbers from Stockopedia, everything is good and fine. Let's move on just to SACs to see a couple of details here. We can see that the SAC rank is 2, and the SAC rank is showing a lot about how the analyst view is that is getting better or worse, if the estimates, if their earnings are getting better or worse. And we can see a 2 is very fine. I like to see 1, 2 or 3. They are all very good. So if we are having a quick look here, we can see that the broker recommendations, just a quick look here, that's the same picture as before. Most of them are up in a strong buy, and that's as we saw in Stockopedia. We can see that, let's see here, earnings per share surprises coming up here. And we can see that this is one of these companies that we just love. They just keep surprising us in a positive direction. So now from the graph, from the Stockopedia and from the SACs, this is absolutely outstanding. One thing I also like to see is that the industry rank of a stock is fairly good, meaning that you can get buy signals on one stock, but if it is in a really lousy industry, that can pull it down. But to be in the top 24%, there's absolutely nothing wrong with that. All right. Let's move on to the last part, and that is the fast graph, and that is where we compare the stock with its earnings. So we are looking at 10 years of earnings here, 10 years of stock price development here, compared with the growth in earnings and price earning here, the blue and the orange line here. And what we can see here is, and that is my only point where I am really I guess you could say nervous, or at least I do have a little to complain about here, because when we're looking at these 3 stocks, we should look at them also on the value perspective here. And what we can see is that there's absolutely no correlation. There's not anything here that combines the earnings with the price. The price has gone up so much faster than the earnings growth has. So I'm a bit concerned here, to be honest. If we're looking at all of the years, let's have a look at that. You can see that there was a long period of time here in after the dot-com crash. You could see that it was above earnings lines here, and then it slowly moved in. You actually had from 01 to, you almost had 10 years actually, where Microsoft just went sideways because it started from a very overvalue point. But then down here you could have bought it, let's just say you bought it at a high point here, but still in the value area, and you had kept it until today, you would have made a nice 24% per year since 12. So the last 8 years you would have made 24% per year. Nothing wrong there. But right now we are in an area where we should be a bit cautious, and that doesn't mean that Microsoft can't go to 200 or 250 or 300, but we are in an area where it is hard to justify the price compared to the growth here. And if we're looking at just quickly the forecasting here, we can see the same. If we should go down to some sort of fair value down here over the next couple of years, let's see here if we can mark it. We might not be able to do that. Here, over the next year or so, if should go down just to get near fair value, we would see minus 25% on an annualized return. And that is the only thing that actually makes me a bit nervous about Microsoft here, and that might hold me back from buying it. That might be another of these three candidates that is a bit better. So let's have a look at the next one, and that is Facebook. Alright, here's Facebook, and as you can see on the graph, it is not the same nice looking trend as in Microsoft. We have had some large downturns here. It was a very nice uptrend from around 12 and then up until 18. We could have made a killing there, but then it went down, broke the trend, and then it started the trend again. It was a very good trend, and then it has been shut down like all of the other stocks now. We can, if we want to, try and make a regression line here to see where we are. And you can see that even though we had the big spike down, we are actually back in the trend line, and I would suggest that this is the point we should draw the trend line from. So it is a fair trend. We can see on the RSI it is above 50, so it is a fair trend. And we can see the comparative relative strength here that is doing way better than the market. So overall we are kind of placed here. The visual graph is not, the visual trend is not quite as nice. We have had this big upturn with the rest of the market, and I would like to see a little retracement before we move on here. But it is up today with 0.6%, almost 0.7%, and it is looking good. If you do want Facebook in your portfolio, this might not be the worst time. But let's have a look at the rest of the analysis tool. Stockopedia, as you know, I do like to have above 90 here, and we have the quality 91, the momentum 80, and the stock rank 79. I'm not looking too much at value here. I'm looking at that in fast graph. So 91, 80, and 79, that is absolutely okay. 2.2 impact ratio, meaning that we are not paying too much for future growth. Microsoft was at 2.8, a bit high. 2.2 is somewhat better, I think. If we are looking at the return on capital, equity, and operating margins, they are extremely good as well. The Petrosky score, only a 4, and we could investigate that a bit further, and I would do that when I go through the stocks quickly. Then I take out some of these worry points, and then I investigate them further. There could be a very good explanation for this. The Petrosky score can be a bit it has very strict and square rules, so it doesn't take much to go from a 6 to a 4, for instance. So that one I would just look a bit into here. If you're looking at the earnings per share, going up just like we wanted to. Free cash flow going up just like we wanted to. Yeah, net debt, that is just that is negative. That is perfect. So we have a current ratio, quick ratio, and interest coverage here. Very, very nice numbers. So Facebook, just as Microsoft, there is nothing here that really worries me. So we'll take it on to the next step. Here we have the SAC. It has a SAC number of 3, so that is also within my criteria here. We can see the broker recommendations. Sometimes SAC can be a bit slow to react. But let's just see the broker recommendations. Here they are. They are very similar to Microsoft. Almost all strong buys or buys. There is one hold, but 1.14. We have 1, 2, 3, 4, 5. So an average of 1.14. I think Microsoft was a 1.13. So that is pretty much the same. Nothing to complain about here. Let's just have a quick look at the earnings per share surprise coming up here, and they have not been quite as well as Microsoft. There have been negative earnings surprises, and not by much. This one at least. This one was bad. That was something I would look into definitely, because the earnings per share surprise is definitely something that you should look into. You can see the industry rank. It is even better than the Microsoft. Microsoft was in the top 24%. Now the Facebook is in the top 18%, so that is even better. Moving on to the fast graph, we can see that this is a point where Facebook is really winning compared to Microsoft. Because looking at the last 10 years of data, we can see that the price has gone a bit up moved into value territory. You can see if you had bought in here in the value territory, there's always almost no way you could have lost money here. 11% per year just from a point here to here. That is amazing. So what we can see here is that the estimates, they are pointing up. And of course, in these times of crisis, we should be a bit aware that the estimates might be moved a bit to the south. They might be a bit off. But right now, we can see that Facebook have estimates of plus 14%, 34% and 20%. And if that is correct, then there's almost no way we can't make money here. That, of course, is a dangerous thing to say. But let's just see the normalized here. If it is just moving along with the overall growth trend here, then we can see that we would be making over the next couple of years more than 30% per year. And even though it should underperform, if it moved down here, we would still be making 16%. And if you have seen my previous stock of the week, you know that this is one of the factors that I really like. It can really drop in earnings per share from the current, 33 and down to, let's just remove this one, and down to around 20, and we would actually almost not lose money. So compare Microsoft with Facebook. I think that Facebook value, regarding value, it is in a way better area than Microsoft. Not that I don't love Microsoft, I really do, and I think they have great potential. But if you're looking at the from a value standpoint, they are both in an uptrend, but Facebook is coming in an uptrend from a very low area. So there's a lot more upside. If we should really move up here over the next couple of years, we can make 70% on annualized returns. So right now, these two compared, if I should choose one of them, I would probably choose Facebook. But let's take our last stock today, and that is Mastercard. Here we go. Mastercard is, when we look at the visual part of it, is there a trend here? Then I must say that Mastercard is the one with the weakest trend. It is not even close to get in the regression channel here as before. The RSI is below 50. The compared to relative strength is not above its two moving averages here. So I would say that on a weekly chart, Mastercard is a very weak candidate. We can see on the daily chart that it has been moving up like the rest of the market, but this one looks a bit more like something you would call a bear flag here, that if it moves down through this channel here, the rule of thumb is that you take this area here or this distance here and move it down here, and you could see Mastercard go down to 140, which means that it could pretty much be cut in half. I'm not saying that that is happening, but it is just to say that on the visual, on the graphical technical part of the analysis, Mastercard is actually very, very weak, at least compared to the two others. And this is, of course, just in my method and strategy. You could easily have a technical analysis strategy where this would turn up way better, but this is from my point of view. I am a bit concerned, and this is the one part where I'm getting a bit into the qualitative analysis. The Mastercard, of course, is also lending money out, as I know it, and people can have it as a credit card. And I'm a bit worried that with the number of unemployed right now, that they might be taking some cuts, some losses from people that can't pay the bills, and might be using their credit card to actually cover other debt with. But that is just a concern I have. If we're looking at the Mastercard from the fundamental side, we have the quality 91, momentum 86, and stock rank 75. That is all well and good, but we can see that the PEG ratio is actually 4.8, and that is really not something I like. That is way too high for my likings. As I said, 2 is okay. I could do with 2.5 or 2.8 like Microsoft had, but 4.8 is way out of the range I would like to see. They do have fantastic return on capital, equity and operating margins, no doubt about it. That is really phenomenal. We can see that the earnings per share is going up nicely. Free cash flow, let's see if that comes up. Just a second here. That is also exactly as we like it to be. The dividend growth, it is growing its dividends. It is falling a bit in the growth here, but the dividend yield, it is only 0.5%, and there is a huge dividend cover, so nothing to be worried about there. Net debt has gone from negative to positive, so they do have net debt now, but nothing out of the it's nothing extraordinary. We can see that they have a nice interest cover, fair quick ratio, and the current ratio is gone in yellow, but nothing to worry about there. Sales growth, earnings per share growth, and that is last interim period versus prior period, has been dropping a bit. But there's nothing really concerning here, but I do not like the PEG ratio. I do not like that the price earning divided by future estimates is 4.8. Also, remember, as I said earlier in the video, that these numbers can change quickly, because if let's say, for instance, Mastercard has revised their estimates and the two others they don't, then we could see that the other two are shooting up to 4.8 as well. So that is something to be have an eye on if you are analyzing this. Now, Mastercard on the SAC rank is a 4, and that actually means that I cannot buy it. I simply will not touch a stock with a SAC rank of 4. Let's dive a bit into, see what the broker recommendations are saying. They are at this point all well and good, 20 strong buys. Yes, nothing wrong there. Let's just see the earnings per share surprises. We do like a stock that is doing a lot of positive surprises, and there's nothing really wrong with Mastercard here. So we just have to be aware that they can surprise positively if they are surprising here the earnings per share, and then they are giving a guidance saying that the year is going to be a lot worse, and then they're coming up with a small profit, then they can actually have an earnings per share surprise here. So that can be manipulated a bit. If we are looking at the fast graph, we can see over the last 10 years that we have the earnings growth down here, the normal PE ratio here, and we can see that the price have simply run away from the overall growth in earnings. So that is also a danger signal. Let's just see here in the forecasting part. If it should, over the next couple of years, move down towards its normalized PE here, we would see a loss actually at -1%. So it had to keep up. It cannot begin losing a lot of money from people not paying their bills. So they have to keep up the pace. If they're just losing a bit of pace here, we can see that they're quickly moving down, and we could be in negative territory very, very quickly. So let's just compare the three of them. We have Microsoft, we have Facebook, and we have Mastercard. Microsoft is, would I say, from a visual standpoint, the best trend. But when we're looking at the numbers and we're looking at the fast graph here at the value, I actually think that Facebook is a way better buy than Microsoft. Mastercard is out of the question. I think there are too many danger signals here. So if I had to choose between these three, Mastercard would be out. That would definitely not come in play. If I should choose between Microsoft and Facebook, I would be tempted to split between the two and then be ready to maybe move more into Facebook if Microsoft's trend breaks. That could be a possibility, but if I had to choose one of them from a value, from a trend standpoint and the numbers, I would choose Facebook. So here you have the judgment here. Facebook is the winner of this little competition today, and I think I am going to make a bit more videos about these stocks of the week competition where I compare 2 or 3 stocks. If you have ideas to a bundle of stocks, 2, 3 or 4 stocks that I could compare, please put them in the comment section below. If you forgot it in the beginning of the video, you have the time now to subscribe to the channel, like the video if you like the content and so on. If you have questions to my way of analyzing, please feel free to write me. I'll do my best to answer you. That's all for now. I'll talk to you again soon, and bye for now.